Hey everybody, we are live. Thank you guys for all attending this live broadcast. My name is Hone Tai, the real estate guy helping you escape your 9 to 5. Today I have with me Mr. Jason Scott. He's a best-selling author. He has 4 books, and his most recent book is about the recession and the economic cycles within. So you definitely want to check that out. He has a new training coming out on that book as well. So he has a training that you can attend. He also has done about 400 flips. He's a father of 2 kids. He does note investing, rentals, lending. He does like the whole gamut of everything. He's running his own businesses as well, and he's buying more businesses. He used to be a poker player, and he has racehorses. And I'm sure I'm forgetting a whole bunch of stuff, but I'd love for you to fill in everybody. Jason, welcome to the call. How's it going?
Awesome. I'm thrilled to be here. I don't normally do these things live, so I love the live aspect.
Yeah, there's an element of surprise because people are going to ask questions. And so if you guys are watching, feel free to ask Jason questions. This is going to be good. So I want people to hear from you because I'm a J Scott fan. I'm a big J Scott fan because I think the way you look at things, you just have this way of looking and analyzing things that it's refreshing because you look at it at angles that are logical, but also from just slightly a degree or two off. That makes a lot of sense too. That makes me think about stuff. Like after I read your post, I'm now thinking for like the next half hour about how to process it all. So I wanted everybody to hear from you directly.
Awesome. I like to think of it as not as thinking of it from a degree or two off. I like to think of it as 1,000 or 10,000 feet higher.
Okay.
For me, it's not so much. It's the perspective. It's being able to see everything that's going on, and instead of being so focused, instead of being so directed at looking for one thing or trying to understand one thing, I like to understand how the interplay of everything. So for example, real estate, we talk about, I flip a lot of houses, but flipping houses is just one piece of real estate. There are lots of different niches in real estate and they kind of all interplay with each other. And especially throughout the economic cycle, some are better, some are worse, some impact to others. There are ways to use different niches in real estate to kind of to hedge your risk and to increase your profits. And then likewise, when you take other forms of investing, when you throw businesses in there and when you throw other types of investment assets and asset classes in there, you start to see that things, there's a lot of interplay between things, and you can use different investing styles, different investing strategy, different asset classes, kind of to all work well together in we talk about diversification, but it's not just diversification. It's actually using different investing styles and asset classes to play off of each other to do 2 things. We're always trying to do 2 things. Number 1, we're trying to increase our returns. And number 2, we're trying to decrease our risk. And so what I tell everybody, and a lot of people, they're generally focused on one of those things. When the market's good, when the economy's strong, everybody's focused on increasing their returns. Nobody's thinking about risk. And then we hit something like this crazy event that we've had going on, or we hit a recession like in 2008 or a normal recession like we've seen in the past. And people stop focusing on profits and they start focusing on just modulating their risk and reducing their risk. And so what I tell people is at any given time, you should be thinking about both of those things. You should be thinking about right now, how do I increase my profits, but also be thinking in the future, think what's likely to happen, what could happen, and how can I mitigate my risk while still maximizing my profit? How can I mitigate my risk in the future by being prepared for what's likely to happen?
Right. So that's definitely something that a lot of real estate investors, they don't consider. And I also think it's because they don't know to consider it. So this may be the first time that anybody has ever heard that we as investors are doing 2 things, trying to increase our profits, but then at the same time trying to mitigate our risk or reduce our risk. Yep. I want to go into specifics. What are ways that people are, what would you say is a way that people can reduce their risk? What are risk mitigation actions that people can take as an investor?
Yeah, so it really depends on what the likely risks are. So at any given point in time, different places, different investing styles, different times of the economic cycle, your risks are going to be different. I'd say everybody should be asking themselves, what risks am I facing right now? So are you a buy and hold investor, and maybe your risks are you have tenants that aren't going to be able to pay, or you have loans that might be coming due in the next year or 2 or 3 that you're concerned about refinancing. Maybe you're a flipper and you're concerned about I want to buy these deals this week, but I don't know if I'm going to be able to resell them. Or maybe you're a business investor and you don't know if you're going to be able to pay your employees because you think a recession might be coming. First, you have to start with what are the likely risks that I might face? And you want to think about that both at a very specific level, like in my business, what are the risks that I know about today? And then take a step back and say, given where we are in the economic cycle, and I've been talking about this well before this whole economic crisis, if we were to head into a recession, which I think at this point there's a reasonable chance we will, and we can talk about that if you want. But if we're going to head into a recession, what are the things we should be doing before we get there that will allow us to be prepared when we get there? So things like I've been telling people for the last 6 or 12 months, be a lot more careful about the flips you take on. And I still say this, if you're going to take on any flips today, make sure that you have a backup plan. Make sure you have a plan B and a plan C and a plan D, so that if for some reason you can't get through that flip, if you can't sell that flip at the end, that you have another exit strategy. If you're a buy and hold investor, I've been telling people, look, when we head into a downturn, there's a chance, it's not necessarily going to happen, but there's a chance that market rents could drop. So if you're getting $1,500 in rent this month, in 6 months, you might be getting $1,300 in rent. We may see occupancies decrease and vacancies increase. So maybe you're expecting that you're going to have 6% vacancy in a typical year. Well, maybe now you should expect 8 or 10% vacancy. So if you're a buy and hold investor, what I tell people is, assume the worst case, or not necessarily the worst case, but assume a negative case and bake that information, bake that risk into your underwriting. So if I'm going to buy and hold right now, and let me tell you something, I'm still looking for buy and hold deals. Even throughout this entire, this economic crisis that we're in the midst of, I'm still looking for buy and hold deals. But when I underwrite those deals right now, I'm underwriting them to assume lower market rent. I'm underwriting them to assume higher vacancy. And I'm underwriting them to assume that I may end up with something like we're seeing this forbearance issue now, where lenders are saying that homeowners don't have to repay, and states are going along with it, saying we're not going to enforce foreclosures, we're not going to enforce evictions right now. So that's another risk. So I'm baking all of that into my models. And if the deal still works out with a 10% higher vacancy, a 10% lower market rent, and I can absorb 3 months of not getting payments because maybe there's going to be an eviction moratorium. If it still makes sense given those circumstances, I'm going to move forward with the deal. Because the nice thing is, in a year or 2 years, we're going to be in the next expansion, and the economy is going to be doing great. And if this deal made sense during a downturn, it's going to make even more sense during the next expansion.
Right. That's where the wealth transfer occurs, when you're buying in the right part of the cycle. So would you say it's safe to say that we're in the beginning of the beginning, as in the beginning of the downturn? So if we were like going up and up and up, and then we started to come back down, are we at the beginning of the beginning?
So I think that this whole thing, this whole economic event that we're in the midst of, this health crisis that we're in the midst of, obviously this is unprecedented. We don't have a lot of examples here. But the way I like to think of it is in 2008, we saw basically we fell off a cliff. So heading into 2008, things were decent, or heading middle of 2007, things were decent. And then within a couple months, everything just kind of collapsed. Typically, that's not what happens during a recession. Typically, during a recession, we'll see kind of a slower, just kind of we glide into the recession. We see the negative downturn coming, and unemployment kind of slowly creeps up, and economic output slows down, and a whole bunch of things happen over 6 or 12 or 18 months. 2008, we saw it kind of like falling off a cliff. This time around, it's very much like falling off a cliff as well. we're likely come next month to see GDP numbers, which is GDP is kind of the total economic output of the country, worse than we've ever seen in the history of this country. We could see unemployment numbers worst we've ever seen in the history of this country. We could see number of hours getting cut and wages getting cut, worst we've ever seen in this country. A lot of economic indicators are going to be the worst we've ever seen in this country. Does that mean that we are in the worst economic time in the history of this country? Probably not. What we're seeing is kind of I like to think of it as in February, before all this started, we kind of all went to sleep. And right now we're kind of dreaming. And in the midst of our dreams, we don't know what's going on in the real world. Like, we're just kind of in our dream state. Everybody's asleep and we don't know what's going on out there. Sometime in May or June, when this whole lockdown ends, it's going to be like waking up from the dream. And in that time that we've been asleep and we've been dreaming, a whole bunch of stuff has happened. It's not as good as it was before we went to sleep. It's not as bad as it was in our dream where everything was collapsing. Things are going to kind of get back to some steady state. We're going to get back to some place that I'm guessing is not nearly as bad as we're seeing today, but not nearly as good as what we saw back in December and January. So where do I think that's going to be? I think come May, June, July, again, whenever we get out of this lockdown, what we're going to see is we're going to see numbers that indicate we're kind of in a typical recession. We're going to see numbers that were similar to 2001 or maybe the early 90s when we had recessions then. And that could be 6, 7, 8, 9, 10% unemployment. That could be GDP numbers at flat or just a little bit growing or a little bit contracting. And things won't be great, but it's not going to be 2008 bad. Now, the bigger question becomes, what happens 6 months after that? Do we continue to head into a regular recession? Do things suddenly get better and everything's great again in 6 months? Or in 6 months, do things get really, really bad? And that's the bigger question. I think the bigger question is not so much where we're going to be this summer. I think I'm confident in saying this summer we're going to see kind of typical recession numbers in the economy. The bigger question is, where are we once the election's over and we get into 2021? And that's where there's a lot of speculation.
Yeah. The thing that I find most interesting is that when I talk to people, a lot of times the only things that they can compare this to is they often say, oh, this is like 2008 this way, and this is like 9/11 that way. And it's like, is that all you got? Is that your imagination? Like, because this is, like you said, nothing that we've ever seen before.
Yeah.
When we get to our next recession, maybe 10 years from now or whatever it is, right? At that time, we're going to be like, oh, is this like the pandemic, 9/11, or 2008, right? And then it's like our brain can only see what we once saw. We can't make up new realms. And that's why I like listening to what you have to say, because you go from a high level and you think, well, this can be very different. This can be very different than everything that we felt and went through.
Yeah, I released a book last year called Recession Proof Real Estate Investing. And basically one of the points that I mentioned several times throughout that book is that no two recessions are ever alike. There's always something different that kind of kicks it off. There's always a different type of snowball effect that takes over once it's been kicked off. So we all remember 2000. Well, so we can start with this one now. This one, obviously, we know what that kind of one event is that kicked it off. It's the COVID-19 crisis. We go back to 2008, and it was the whole lending mortgage industry. We go back to 2001 or the late 90s, and that was two things. That was the tech bubble and 9/11. We go back to the late 80s, early 90s. That was the savings and loan crisis. Anybody that's old enough to remember the savings and loan crisis. We go back to the 70s, and you go back to the early 80s. There was a housing crunch. You go back to the 70s. It was oil. You go all the way back to the 1930s, and it was tariffs and debt, very similar to what we're seeing today. But every recession is going to be different. And to say that this one is like that one, yeah, we can kind of say that. We can definitely say that the initial conditions, so the things that we're seeing leading into the recession, are similar. But once you're in the midst of it, there are these dominoes, and we never know which dominoes are going to knock over which other dominoes, and which dominoes are going to fall, and when the dominoes are going to stop falling. And so every recession is going to be different. And I made a point when I wrote this book. When I originally wrote the book, it was going to be, here's what to do at the different parts of the economic cycle as an investor. Here are the things to think about. Here are the strategies to follow. Here are the tactics to follow. Here are the things to think about for the next part of the cycle to prepare for. And that was going to be the book. And then I realized that laying out that kind of set of heuristics, if the economy's here, do this, if the economy's here, do that, that was way too limiting, because too many people, they're going to follow that advice without really thinking about how these things work. So I then said, nope, I'm not that. The book has to be more than that. So I actually doubled the size of the book, and the first half of the book is actually an introduction. It's kind of like an introduction to macroeconomics and how economic cycles work, why they work, all the indicators that we need to look at, how different parts of the economy interplay and work with each other. Because I think it's really important for people right now, not just to ask me the question, what should I be doing now? What should I be doing next week? It's one of those teach a man to fish versus give a man a fish. I can give you a fish. I can tell you what you should be doing right now or next week or next month. But the problem is, if you don't understand how the economy works, you're going to be listening to my advice, but my advice might not make sense, because this recession might not be like the last one or the one before or the one before. So it's important for everybody to understand how the economy works, so that instead of asking people what I should be doing, you can say, based on what I'm seeing, I can reason, I can use logic to determine that this is what I should be doing. So what a lot of people who follow me on Facebook will realize over the last 12 months, and especially the last few weeks, I don't necessarily talk about this is what I think you should be doing, because I don't know you. I don't know your business. I don't know your location. I don't know your strategies. I don't know your time commitment. I don't know your cash position. I don't know anything about you. Instead, I say, here's what you need to understand about how the economy works. And then you can take that information and you can figure out what you should be doing. Because let me tell you something. I might tell you what you should be doing. I could be wrong. You might be smarter. Once you understand how the economy works, you might be smarter than I am in how to apply that to your business. In fact, you're certainly smarter in how to apply it to your business, but you might just be smarter in general. So learn about the mechanisms for the economy, and then you'll be able to figure out, no matter where we are in the economic cycle, what strategies and tactics you should be pursuing.
Love it. So what you're saying really is, people need to have a foundational understanding of just how things work. And then from there, they can come up with their own ideas. So they learn how to fish versus being given a fish.
Yep.
A conversation that I had about an hour ago, a friend of mine, he's not in the real estate business, and said, Hone, I want to do a flip. I want to do a flip. And I said, okay, tell me the numbers. He said, oh, I just did the ARVs last month and they came in at 250. And my purchase price is this, my rehab is that. And then he just started telling me the numbers. And I'm like, did you factor in how things are today? Because that ARV, based off of things that sold in January and February, don't necessarily apply today. And to be safer, I would knock off, say, 20%, because in 6 months or 3 months from now, when you're done the rehab and you go to sell it, who can actually buy it and at what price? And those are the kind of thoughts, like you were saying earlier, what are the mitigating factors? How do you mitigate your risk, and what risk exists? So when he goes to sell it at the end, the big risk is, who's going to be there to buy it and at how much? Will lending be there? Will the credit be tightened so much that only a handful of borrowers now exist? So if you have a pool of buyers that shrunk, then your price is going to go down because the competition is going to be so much higher for those remaining buyers.
Exactly.
So all those ideas.
Yeah. We talk about risk a lot. Well, what is risk? Risk is basically just unknowns. If we know everything about what's going on in the economy, if we had all the information and we had the perfect computer to analyze it, there'd be very little risk. The problem is there are a lot of unknowns. And let's use your example of a typical flip. When you're doing a flip, most things are known. You know what this property is worth today. You know how much it's going to cost to renovate it. You know how long it's going to take. You know what materials you're going to use and how much they cost. You know how much your holding costs are going to be. You know how much your mortgage is going to be. What don't you know? The thing you don't know for certain is what the value of that property is going to be the day you go to sell it. So there's one big unknown. And if the economy is pretty stable, it's not even that big of an unknown. I mean, I've done over 400 flips. I've lost money on one of them. And it's not because I'm lucky. It's because, one, I've flipped during a very good time in history. Basically, prices have been rising, so it's hard to make a mistake. But also, I do my research, and I know as close as I possibly can what all those known factors are. And if you can get 99% of the factors as known, then that one unknown isn't going to hurt you too bad. Here's the problem with doing a flip right now. Doing a flip right now, there are a lot of unknowns. It's not just that ARV at the end. That's a big unknown. And that's a bigger unknown than it normally is. But we don't even know what a property is worth today. If I go to buy a property today, if somebody says, hey, I'm going to sell you this property, last month it was worth $250, I'm going to sell it to you for $150. Am I getting a good deal? I don't know. I know that a month ago it was worth $250. I don't know what it's worth today because we don't have an efficient market. And by efficient, I mean we don't have a market where there's as many buyers and sellers who want to be out there negotiating as there could be. There are a lot of buyers out there who are sitting on the sidelines. There are a lot of sellers who are sitting on the sidelines. So we don't have a good insight into what property values are today. In certain markets, people say, yeah, I'm seeing houses that are selling above what they were a month ago, or half as much as what they were a month ago, or exactly what they were. But the problem is there's not enough data that we can say this is what a property is worth today. So buying something at $100,000 less than a month ago doesn't tell me if I'm getting a good deal or not. Likewise, I don't know what things are going to look like when I go to sell. I don't know what ARVs are going to be. I don't know if buyers are going to be out there looking at houses. I don't know what the price of materials and labor are going to do over the next 2 months. It's very possible they're going to go down because they're out of work contractors who are desperate to find jobs. But potentially all these contractors don't want to go out because they're worried about the virus. So they're going to stay at home. And now there's going to be a labor shortage and prices are going to go up. So again, risk is basically all of those unknowns. And right now we have more unknowns than probably any time in my lifetime. And a month or two from now, when the lockdown ends, a lot of those unknowns are going to kind of reveal themselves and they'll be knowns again. And there'll still be more risk because there'll be more unknowns, but not as bad as it is today.
Right. So the uncertainty is high. The uncertainty is high, and that's why a lot of the investors that I talk to, they're sitting on the sidelines just watching. They're not necessarily taking action, buying properties, things like that. They're just watching. And so that inefficient market that you speak about, that is our competitive edge when it comes to real estate investing. And this is often why we choose to invest in real estate. Because when you're in the stock market, you buy a stock, you're buying it in a very efficient market. The price you buy it for is the price that it is. But if we buy a house today for $100,000, it could be worth $200,000 or it could be worth $50,000. We don't know. It's for sale for $100,000, and that's crazy. Now, before we move on, I'm going to allow you to do a little plug. Lenny asks, "Can you please repeat the name of your book when you get a moment?" So,
yes.
What's the book that you just talked about, and what are the other books that you wrote?
Yes. So the book that I just talked about is called Recession-Proof Real Estate Investing, and my publisher is Bigger Pockets. So if anybody's familiar with Bigger Pockets, it's available on Amazon or Bigger Pockets, Audible or Kindle. The paperback version of that book will be available in a few weeks. And my 3 previous books are the book on flipping houses, the book on estimating rehab costs, and the book on negotiating real estate.
Awesome. A lot of value in all of those books. Those are actually some of the ones that come up often in my conversations. People are always like, Hone, how do you estimate rehab? Hone, I want to flip houses. So those books are like spot on. And then how convenient. You wrote a book on a recession, and here we are. So what are you doing? What are you doing these days now that all of this craziness is happening?
Yeah, so I kind of I don't want to use the word predicted. I surmised about a year ago that we were going to be facing some changing economic times. I did not expect, I never predicted that we would be seeing what we're seeing, obviously, with this pandemic. I don't think a lot of people did, though some people clearly saw it as a risk. But I certainly saw that based on the research I was doing, the data I was seeing, a lot of that data I've been talking about for a year, that's kind of led me to believe that at some point soon we were going to see a downturn. So I've kind of been preparing my business for the last year. We've slowed down on flips. We've been focused more on buy and hold. We've been changing our lending guidelines. We do a lot of lending, but we've mostly been lending on cash flowing properties as opposed to flips. We recently launched a business that was a good recession resistant business. We've been negotiating to buy some other businesses. We've been shoring up our cash position, so we've been trying to have more cash available, like you mentioned, and I often talk about. During a recession, during a downturn, lending often tightens up. So having access to cash is a big competitive advantage for investors that can. I've made sure to refinance any loans that were coming due in the next couple of years, because I don't want to get caught with my pants down in a year or two when one of my loans comes due and I have trouble refinancing. I'd rather get a new 5 or 10 year loan now. And we've been very opportunistic. I mean, that's kind of during a big economic shift. If you anticipate a big economic shift, or you're dealing with a big economic shift like we are right now, being opportunistic is probably the best thing you can do. I'm not putting all my eggs in any basket, and I'm essentially in wait and see mode. If a great deal comes along, whether it be on a flip or a rental or a business or any other type of asset that I want to invest in, I'm going to jump on it. I'm not going to say no if it's a great deal. But right now, I don't know exactly where we're going to be 6 or 12 months from now. So I'm very much in wait and see mode.
Gotcha. Now, in one of your posts, you said that people who went through 2008 were kicking themselves for not buying enough real estate, right? Because it was like doom and gloom for real estate and it's the worst thing to buy. But those who bought in 2010, 11, 12, or whatever, they've just experienced all up from 2010 to 2019. It was all up, even to 2020. You said for this downturn, the same thing's going to be happening, but for businesses. I am not necessarily a person who knows how to buy a business, because there's like EBITDAs and all of that other stuff and multiples, right? How are you looking at purchasing businesses? How do you go about doing that? I have no idea the first step of analyzing business to know how to go about doing that. And how do you even buy one? Because you get bank financing? Like, I don't know. So how would you go about doing that?
Yeah. So first of all, keep in mind that I'm not suggesting everybody go out and buy a business. What I say is I think there's going to be a huge opportunity. I liken the business opportunity over the next 3 years to what the real estate opportunity was back in 2008 to 11 or 12. There are a whole lot of people that look back and say, wow, I really wish I would have gotten into real estate back then, but I was too scared to do it because there was a bloodbath going on. And well, what we're seeing is a bloodbath for businesses these days, for a lot of reasons. After this economic event is done, after this lockdown is over with, there are a lot of businesses that aren't going to come back. There were a lot of people who were running businesses. I've run a business before where after 2 or 3 or 4 years, I said, I really shouldn't be doing this anymore, but I put so much time and money and effort into it. I'm not ready to shut it down. And I drag it out and drag it out and drag it out. And there are a lot of people that were doing that as of a month ago. This event hits and it's the perfect opportunity for them to say, okay, well, that's the sign. I'm not gonna keep doing my business anymore. This is the perfect opportunity for me to shut it down. So there are a lot of people who are going to do that. Then there are going to be those business owners who are basically, this was just like the straw that broke the camel's back. They were like, this was too stressful for me. I can't do this anymore. I just want to go get a job again. I'm not cut out to be a business owner. And in a month or two, they're just going to shut down their businesses and go get a job. And then the third category is people who decide, I was getting ready to retire. Maybe I'm 60 years old or 65 years old, and I've been running this business, and I was getting close to retirement age. And now after this event, I basically have to start from scratch in my business. I have to get all my employees back. I have to get all my customers back. I was going to retire anyway. Maybe now's the right time to just retire. So you add all those categories of business owners in there that aren't going to come back after this thing is over. And that's literally millions of small businesses that are not going to be around in 3 months that were around 3 months ago. And so just like back in 2008 with all the foreclosures and all the houses where the sellers were just they were desperate. They couldn't keep their houses. And it was a great opportunity for investors to kind of come and buy up cheap houses. It's going to be the same thing with businesses over the next year or two, I think, where there's going to be a lot of businesses where the owners are willing to sell really cheap. They're motivated sellers, just like in real estate. A lot of what I talk about in business, it's so analogous to real estate. When you understand how business works, you can always, everything you talk about, it's like, well, it works exactly the same way in real estate. And just like in real estate, there are motivated sellers who are desperate to sell based on the big D's: divorce, death, disaster, relocation. And it's the same way in business. That's the reason people sell. They sell because they're going through a divorce. And I'm negotiating a business right now where basically the wife doesn't want to be part of the business anymore and is forcing the husband to sell. They're disaster. There are people that just bad things happen, and death, somebody dies, an owner dies, and the other owners are looking to sell it off, or the heir is looking to sell it off, or somebody has to relocate and they're looking to sell. Same reason people sell real estate or desperate to sell real estate are the reasons people sell businesses. So there are going to be a lot of people right now that are going to be willing to sell their business and sell their business cheap. There are a lot of, I've talked to owners over the past couple of weeks who've basically said, I know my business isn't going to survive. I don't care. All I care about is that there's some continuity for my employees. I don't want to have to fire all of my employees. Let's talk about selling the business, and I'll give you a really good price. All I ask is that you promise not to fire my employees. Just keep paying them, keep this business going. And so there are a lot of business owners that are going to be in that particular frame of mind right now. So again, very analogous to real estate. How do you buy a business? Just like real estate, you can bring all cash to the table. You can get a loan. You can go to the SBA, the Small Business Association, and you can get a loan up to generally 90% to buy the business. You can do a combination of loan. You can do a combination of loan and cash. And just like in real estate, lots of seller financing in businesses.
I was just going to say seller financing.
Absolutely. There are a lot of owners who, if tomorrow they're going to have to shut their business down and you say to them, I'll make you a deal. I'll give you $10,000 a year for the next 10 years. Or maybe they have a good business and the business is worth $200,000 or $300,000 or $400,000. And you say, I'll make you a deal. I'll give you $600,000. I'll give you more than the business is worth, just like in real estate. But I want good terms. I want low interest rate, and I want to be able to spread it out over a long period of time. So just like in real estate, there are lots of ways to buy businesses, but you don't need to bring all cash.
Right. Your price, my terms, or my price, your terms.
Exactly.
Yeah. Irfan asked, what are some industries you're targeting in regards to buying a business? And my question is, how do you price it? So you were talking about overpaying. How do I know what the price is at all?
Yep. So good questions. So let me start with, just like I could tell you I am flipping houses in Sarasota, Florida, where I live. That doesn't mean I think you should be flipping houses in Sarasota, Florida. Maybe you should be doing buy and hold in Nashville. Maybe you should be doing lending in San Francisco. So I can tell you what industries I'm looking at and what types of business I'm looking at. But keep in mind, what's right for me isn't necessarily right for you. And just like with real estate, lots of different niches, lots of different types of businesses. And so don't, because I'm saying this, don't assume I'm suggesting everybody do this. For me, though, I like service industry. I like service businesses. I've done product businesses. I've done service businesses. I am much more a fan of service businesses because I am not a marketing sales guy, and my natural abilities align better with service industry for marketing and sales than with products. Number two, I like industries or businesses that align well with my core investing strategies, my other businesses, my other investing strategies. I do a lot of real estate, so I like businesses that are in the real estate industry. So recently we started a fire water mold remediation business. So a business that goes in if your house floods or burns down or you have a mold problem, basically we go in and remediate it. And so that aligned very much with my core business, which is investing. I know the business well. I have a lot of connections in the industry, so I can use that for my marketing and my sales. I've got a name in the industry, so it gives me some credibility. So I like that, as opposed to going out and starting a restaurant that would be completely foreign to me. Right now, we are negotiating a couple businesses. We're negotiating a granite and marble business. We're negotiating a roofing business. Again, synergies with the stuff that we're doing, and that feed in well. We can kind of play off of each other in these businesses. Third, I'm looking for businesses that are recession resistant. That was the reason I started the remediation business, because the remediation business is very recession resistant. Doesn't matter upturn, downturn, middle of the economic cycle. People are going to have houses that get mold, that flood, that have fires. So they're going to need these services no matter what. They're emergency type services that you can't say, I'm going to push that off for a year or two until the economy improves. And number two, most of our customers, while we're serving homeowners, most of our actual customers, the people paying the bills, are insurance companies. So that's pretty recession resistant. We don't have to worry about a customer not paying us because they lost their job or they got their wages cut or negotiating us down. These are generally fixed price contracts that are based off of software estimates that aren't being negotiated. The insurance company is just paying us based on what we invoice. So I really like the recession resistant. And so for me, it's easy to pick those businesses that I want because it hits kind of those three main targets. In terms of what you pay for a business, that's a great question. Just like real estate, as little as possible. If a business is worth $500,000, I want to buy it for $200,000, just like with real estate. And so how do you do that? That's the question. Well, the big way to do that is you find the motivated sellers. Again, just like real estate. If you find a motivated seller, they're going to sell the business for less than it's worth. And these days, because a lot of people are going to be selling their business and not a lot of people are going to want to buy a business right now, you're going to find those motivated sellers. So the absolute best case scenario, and we had a guest, my wife and I host a podcast called the Bigger Pockets Business Podcast. And we talk to small business owners. We talk to people who buy businesses and sell businesses and experts. And we had a great guest on a couple months ago. His name's Britt Foshi. And basically he buys landscaping businesses. And he buys a lot of little landscaping businesses. He puts them together, creates a big landscaping business and sells it. And it's a great business model. And when we were talking about, well, how do you decide how much to pay for one of these businesses? Because I asked that exact same question. Basically, what he said is, number one, as little as possible, just like in real estate. But what he said was, I try and get the business for the value of the equipment that I'm getting with the business. So if I'm buying a landscaping business, it's going to come with lawnmowers and those big machines and trimmers and trucks and all these other assets, all these physical equipment. And I try and buy it for the value of that equipment, or as close as I can for the value of that equipment. So that way, even if the business goes bust on day one, I can resell the equipment and I'm made whole. So that's the first thing I would say. That was some of the best advice I heard for buying a business. What you should be targeting. And this, again, let's use the analogy in real estate. If I said you were going to buy a house in real estate, typically I say the lowest price you're probably going to get for a piece of real estate is whatever the homeowner owes on their mortgage. Anything less, they're going to have to come to the table with money. And nobody wants to come to the table with money. But there are plenty of homeowners out there that will sell for the exact amount that they owe just to get out from under that mortgage. In the business world, the lowest price you're typically going to get is the value of all the equipment and real estate and inventory and furniture and stuff that comes with that business. Because to take less than that, they could just sell it off and just get that price. So that's typically the lowest. Now, what is a business worth? It's a little bit more complicated. It's like asking me, how do I run the numbers on a buy and hold property or a flip or a multifamily? I could show you the equations. It's a little bit more detailed than what I can explain just kind of here on Facebook, but I can give you a general idea. Just like I can give you a general idea of what a flip is worth and how you value a flip. In general, a business just like real estate. Again, I keep going back to real estate. What's real estate worth? What is a buy and hold piece of real estate worth? What's an apartment complex worth? It's based on
divided by cap.
NOI divided by the cap rate. So NOI is the income that the property brings in, and the cap rate is basically the percentage return that a buyer expects. Exact same thing with the business. So the value of a business is based on the income it brings in. So something in the business world, we often refer to it as the seller's discretionary income or something like that, which is the total amount of money that would flow to the owner of the business in a given year. So that equals the profit it makes plus whatever the owner's salary might be, plus if the seller uses the business to take free vacations. So that's kind of part of the seller's benefit. So that's the income of the business. And then there's some multiple of that a business is worth. And it really depends on the industry and the location and a whole bunch of other things. But generally speaking, for a typical service business, like if you're going to buy a roofing business or you're going to buy a remediation company or something like that, typically the multiple is somewhere in the 2 to 3 range or 2 to 4 range. So if you have a business that's bringing in that an owner, if I bought this business today, or if I took over this business today, if I could at the end of the year make $100,000 for my efforts owning that business is probably worth somewhere between $200,000 and $400,000. So that 2 to 4 multiple of income. And again, just like real estate, it's that multiple, which is the cap rate, and the NOI, the income of the business.
Right. So with the NOI calculation, it's not necessarily because you open my eyes to a couple of different things, right? So with the NOI of a real estate business, it's the rent coming in minus your taxes, insurance, utilities, fire alarm system, blah, 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 blah.
Yep.
Here we have to factor in. So the expense is one of the line items for expenses is the owner's salary.
Yep.
So we have to bake that back in as well as trips and all of that kind of stuff. So we have to bake that back into the income part.
Yep.
Because we, as the buyer, would be getting that. So
right. It's the total benefit to the owner, not necessarily the profit of the business.
The business, right.
Because
would it be a good way to look at it this way? So with real estate, it's all about your well, not always, but just like your ROI. It's like, I'm going to be putting in this much money, I'm going to be getting this in return. And then you're going to be looking across the board at what are my opportunity costs if I do this one versus that one, right? So yep. With the business, if I'm looking at the potential income and I'm going to buy this business, do I divide it by, let's say, all my money, if I was doing private lending, I could get, say, 16%. Should I divide the NOI by a 20 cap to get the value of what I'm willing to buy this business for?
That's essentially what you're doing when you do the 2 to 4 times. I mean, that's somewhere between 25 and 50% cap rate. If you pay cash for that business, you're expecting to be paid back within 2 to 4 years, as opposed to, let's say, a real estate deal that has a 5% cap rate, where if you buy it for cash, you're expected to be paid back in 20 years. And what is a cap rate? A cap rate is a reflection of
the ROI on a property you buy cash.
Right. But more importantly, ROI or cap rate is a reflection of risk.
Oh, yes. Yes.
So if you have no risk, you put your money in a savings account. What's your risk in a savings account? With FDIC insurance, your risk is 0. That's why you basically get 0.25% return on a savings account, because there's no risk. And for a multifamily apartment complex, Class A in New York City, your risk is pretty low. So you're going to pay 2 or 3%, or you're going to get 2 or 3% return. Now, you go to a more risky asset, a mid-sized apartment complex in a tiny town, you might get 6 or 7% cap rate because your risk is higher. Your cap rate, your ROI is just a reflection of your risk. In a business, typically your risk is going to be a lot higher than in an apartment complex, because it's not a business where you basically set it and forget it. You have to constantly market. You have to constantly work. You have employees. I mean, it's risky. So your cap rate's going to be somewhere between 25 and 50%.
I was going to say, if you do a 2 multiplier, then that's a 50% cap rate And
Yep.
then if you do a 3 multiplier, then that's a 33% cap rate. Now
Exactly.
I'm seeing the connection. Got it.
Exactly. So typically you're looking at 25 to 50% cap rate. If to use that term, we don't typically use cap rate, we use multiple, 2 to 4 times multiple, but that's equivalent to a 25 to 50% cap rate. So businesses can be tremendously lucrative, but they are certainly more risky than a stabilized apartment complex.
Yeah.
But by the same token, you can get a 25 to 50% cap rate on a value add apartment complex. You can make tremendous money on a value add apartment complex that's run down. You have to put in a whole bunch of capex. You have to raise rents. You have to lower expenses. You have to put good management in. You're getting paid for taking that risk.
Sounds
Same
like
thing
buying
with
a
the business.
Yeah. Okay. No, this is making a lot of sense. And the fact that because I know the foundations, right? Like I know how to fish, even though I come from the real estate world and you're telling me about the multiples, and then it's like it's clicking. Oh, all that means in English in my head is that it's a 33 to 50% cap rate if you're asking for a 2 to 3 multiple.
Yep.
Okay.
Exactly.
Got it. Easy.
Exactly.
Easy. Awesome. I like that you talked about your mold remediation business and you brought up the fact that the end payer, because it's not the person who benefits from it, but the person who puts the bill is the insurance company. Yep. So that's you thinking a couple of steps ahead in terms of how do you mitigate your risk, because you could buy a roofing company, but if your roofing company is paid by the homeowner and maybe they don't necessarily want to redo the whole roof and they just want some muck in the corner, that's not going to be a big payday for you. But your roofing company has synergy with the mold remediation business because you're going to be doing the roof, and then who's going to foot the bill again? The insurance company.
Exactly. And here's the other thing I like. Here's the other nice thing about the mold remediation business. Little tip out there for all of you real estate investors that are thinking about getting into a business. The mold remediation business is a great source of deal flow. So there are people that, let's say your house burns down. You call my company to come in and kind of board it up and clean up the soot and basically give you a bid to rebuild. You turn that bid into your insurance company. The insurance company is going to cut you a check to do that work. You don't need to rebuild the house. As long as you're still paying, as long as you still pay the mortgage. I mean, if you have a mortgage on it, they may require that you pay off your mortgage before you just walk away with that check. But they're going to give you that check. You don't need to rebuild if you don't want to rebuild. So let's say you decide, I just got a $200,000 check. My friend Taro Yarber, so a lot of you probably know Taro Yarber out there. He had a property, an investment property last year that burned down. And basically he took the check. It was arson. He took the check and sold the property for the land value. And he ended up making more between the insurance company check and selling off the land than he would have had he actually rebuilt it and completed the flip. So a lot of times in this business, we get homeowners that get their check and say, I just don't want to rebuild. I'd rather take this check and buy something else or move somewhere else. And now suddenly they're motivated sellers. They're looking to get rid of their house, and we're right there talking to them, giving them advice. And so we can make them an offer and potentially buy their house. So we've gotten some deals that way.
Yeah, that's awesome. That's awesome. So we have a question. You remember Natalie?
I remember Natalie. How's it going, Natalie?
She said, how do you decide whether to buy or create a new business? Example, restoration, roofing. So I can start a roofing company today. I can start a mold remediation company, or I can go out and buy one. So how do you decide? How do you decide?
Well, let me ask you a question. How do you decide if you should do new construction or buy a flip? Again, it's very analogous to real estate. So depending on what type of business you want, what location you're in, you may find that the quote unquote replacement cost for a business is more expensive than just going out and buying a business that already exists. So it might cost more for me if I can buy a roofing business where I can get the license, where I can get the brand name, I can get the website, I can get the equipment, I can get the trucks, I can get the history of good reviews, all for the same cost that it would take for me to start up the same business. I'd be crazy to start up a new business. I can get it for the same price. Maybe I can get it for less, because if that if that business owner has already paid off their truck, they've paid off the equipment, they're probably happy if they're, well, not probably, but maybe they're happy walking away and even taking a loss on that stuff. They just want to get something out of the business. I might be able to buy that business for a whole lot less money than it would take to start it up myself. So just like in the real estate world, you have to look at replacement cost to determine if it's cheaper to build new or to buy a flip. And same thing in the business world. So what's your skill set? What's your goals? How cheaply can you buy a business? All those kind of factor into whether you should start a business or whether you should buy an existing business.
Right. Part of the inefficiency of a business, from what I just heard from you, is that there's this factor of goodwill that has cost. And for those who don't know, goodwill is, it's like the reputation of your company. And if your company has, like Jay was saying, good reviews and a logo that's recognizable or a phone number that has a jingle or anything like that, that's all goodwill. And that has value, right? That has value. And if it has value, a lot of times the owner may not know how to value it.
Exactly.
And so just getting it for the cost of the parts.
Yeah. So our remediation company, I was looking at different businesses, and again, I was looking for something recession resistant, something that meshed well with real estate, something that could potentially aid in deal flow, something that had high barriers to entry. I really wanted something that, like, not everybody could just jump into, like, easily and compete with me. And the mold remediation business just was absolutely perfect. So I started looking around, and a guy that I had partnered with on some flips, he owned one of these businesses, but he was absolutely done with it. His partner had bailed on him. He had run this business so well, and it was doing so well, but he was just tired. He had run the business for a decade, and he said, I just want to flip houses. And that's how he found me. He's like, hey, Jay, let's flip houses together. And we started flipping some houses together. And a few months in, I was like, well, you mentioned this remediation business. Let's talk about that. And as he was telling me, it was like he was the perfect motivated seller. He had a successful business, but he was just burned out. The guy that was running the business, his partner ended up going and doing something else, and he was just ready for a change. And so I said, look, I'd love to buy this business from you. And he said, well, what's your vision for the business? And I was like, well, I want to grow it. I want to franchise it. I want to make it a nationwide company. He said, well, that actually excites me. I don't want to run the business, but I love your vision. How about we partner? And I can help you. You can take my brand. I have trucks. I have equipment. I have a marketing team. I'm still getting deal flow. I've got great goodwill. I've got all these online reviews that are fantastic from 10 years ago. I just don't feel like running the business. So how about this? You come in, you buy in, we'll partner, you run the business, you focus on the expansion strategy, you focus on the franchising, the growth. I'll focus on running the day-to-day because I actually enjoyed that part. He said, I actually enjoy that part, and we can work together. And it was the perfect synergy. I got all the benefits, like you said, of the goodwill, of the brand name that had been around for 10 or 15 years, of all the great reviews that they had gotten, the trucks, the employees, all of that. And basically I got in for, and he's probably listening to this, thanks, Cliff. I got him really cheap because otherwise he was just going to shut the business down. So he would have rather have me come in for a little bit of money and 50%, giving him 50% of the equity in return for, as opposed to me kind of like him just selling the business to me. So he was going to sell it anyway. So at least this way, right, he now has 50% of the equity and the upside.
So Natalie has a follow-up question. Why would they sell it for so little? Like, example, below equipment costs or replacement. What does that say about the exit strategy? And I think it's because it's emotional sometimes. And then there's also the ease of the transaction. You're there looking to buy it. And yes, maybe I can go out and I can sell it for parts. That means I got to sell a truck. I got to sell a cash register. I have to sell a sign, whatever it is. And that's a lot of work. But you're here and you're willing to give me 75%. Take it. Just take it. Right. So that might be one reason why.
Yeah, let me give you two examples. One, I just told you about my remediation business. So my friend Cliff is one of the smartest people I know. My partner Cliff is one of the smartest people I know. But he was burned out. He didn't want to run this business anymore. And so he didn't even want to have to deal with finding a business broker and figuring out how to sell it, because he's not a business guy. He's an operations guy, and he's a great operations guy, but he's not somebody that like had ever bought or sold a business before. He's run businesses. He's started businesses. He's grown business. He's never sold a business. So it never even occurred to him that he had this business that was making $2 million a year. It never occurred to him, instead of just shutting it down and going to flip houses, I should find a business broker and sell the business. So he kind of just started ignoring the business. He went from a $2 million business to a $400,000 business, and he could have sold it for a lot of money, but he didn't know. He didn't think about it. He was tired. He was burned out. He was frustrated. And so when I came along, like I offered him more. He probably, if I hadn't have come along, he probably would have just shut down the business. And there are a whole lot of people out there that do that. I know that firsthand because back in 2014, I started a product business, educational electronics project. My partner and I sunk a couple $100,000 into the business. The business was going okay. We were making some money, but we could never really scale. We never got to the point where we figured out how to get the materials cheap enough and the production costs down enough that we could scale the business. So after a couple of years, we said, look, the business was making money, but it was never going to make a tremendous amount of money. So we ended up shutting it down. In retrospect, somebody would have been happy to buy that business, even if they only gave us $10,000, even if they gave us $20,000, even if they said, we'll give you 10% of the revenues for 10 years, even if they would have said, we'll give you a $50 Amazon gift card, somebody would have bought our business. But we were so tired, we were so done with it that it never even occurred to us to go out and try and sell the business. I consider myself a pretty smart guy, but I basically shut down a business that in retrospect was worth $50,000 or $100,000. Right. And so if I'm going to do that, there are plenty of people out there that
less savvy, less sophisticated, that would just close the doors versus doing the work.
Exactly.
Like, people are just tired and they just don't deal with it. That in real estate, it's the same way. Why is it that a real estate investor can go buy a property with all of this excess equity in it, and then we can do this, that, and the other and make it so much better? Why would an apartment building be sold at the valuation based on the vacancy? Why doesn't the owner just fix it all up, raise rents, and then, like the whole bit, but they just don't want to.
Here, let me explain it this way. We often talk about, we've mentioned the term efficient markets in this discussion a little bit. And basically an efficient market is a market where things in that market buy and sell for exactly what they're worth. The more efficient the market, the more things sell for exactly what they're worth. So an example of a tremendously efficient market is the stock market. It is really hard, even if you're one of the best hedge fund managers in the planet, it's hard to make money in the stock market because all the information is baked in. It's very rare that you're going to have an advantage over the other 100 million, 200 million people that you're buying and selling against in the stock market. You can't have that advantage. It's such an efficient market. If you find a piece of information that's worth like a 0.25% of a penny, you need millions of dollars of investment to exploit that advantage. So the stock market's a tremendously efficient market. The reason why people make money in real estate is a much, much, much less efficient market than the stock market. People don't know. Sellers aren't sophisticated. They don't know what their property is worth. Buyers don't necessarily know what their property is worth. There aren't, unlike in the stock market, where if you want to go buy shares of Microsoft, there's 10 million people out there competing with you. In the real estate market, if you want to go buy a house, if you find an off-market deal, you may have nobody competing with you. If it's on the MLS, you may have 10 or 20 people competing with you. It's not an efficient market. Well, you know what's even less efficient? You know what market's even less efficient than real estate? Businesses. Businesses are less efficient than real estate. So there's even more advantage for somebody that knows what they're doing in the business world because that's a market that's even less efficient than real estate.
Oh, man, Jay, why am I talking to you? See, conversations like this mess me up because I'm thinking, okay, I'm just going to put my head down and buy real estate. And I'm like, what businesses do I buy? So here's what's interesting. So I'm at a bank because I do a lot of loans. And so I'm at a bank and the president of the bank sent out an internal memo and said, hey, guys, who wants to do this? Please reach out to all of the businesses in the area to see if we can help them with getting the SBA loan. And then in the future, they may remember us for getting them the SBA loan, and they'll come back for more SBA loans or real estate loans or whatever, right? So long-term relationship. Now I'm thinking I'm going to make these phone calls, then I'm going to buy their business.
Mhm. It's just like in real estate. The negotiation process is simple. Start a conversation. Hey, how are you doing today? How are you struggling during this time? Is there anything I can do to help you? How's your business going? Oh, you're really frustrated. Well, what are your plans? Oh, you were going to sell the business anyway in a year or two, and now you don't know what you're going to do. Well, let's talk.
Or even better, I come in with the approach like, hey, I'm just here to help you. I work over there. I want to get you this loan. What are you going to do? They're like, oh, no, don't even worry about it. I'm going to shut my doors.
Yep.
Wait, I have an idea. How about I give you $4 and then we work it out?
Yeah. On the business podcast, we interviewed, it was 2 or 3 weeks ago, we interviewed a guy who he owns the number one bar in the country as rated by company called Barstool Sports, which is
I heard that one.
Yeah, and he was great. I mean, the guy was absolutely awesome. But being the number one bar in the country, he's got a lot of insight into the industry. And he was saying he had talked to a bunch of people in some national restaurant associations, and they were talking about worst case scenario, up to 75% of independently owned restaurants may not return from this particular event. So think about that. We're not talking about the big chain restaurants or the high-end restaurants, but the independently owned small restaurants, up to 75% of those may not come back. How many businesses is that? And that's just the restaurant industry. Think about all the other industries where all of these business owners are thinking, this just might be it for me. And how thrilled some of those would be if you said, I'll give you 10% of revenues for the next 5 years to sell me your business. If they were just going to shut the doors anyway, I mean, just getting anything out of their business, or if you just said, I'll keep on all your employees, I promise not to fire a single employee for the next 12 months. They may be the type of person that's great. Take my business, just treat my employees well. So lots of opportunity.
Yeah. So it's very much like with the sellers. I remember this one seller who was interested in what I was going to do with the property. And they didn't want to sell to these other people because they simply wanted to buy the house, renovate it, and do Airbnb. And they're like, no, we can't have that. We don't want that.
Yep.
Even though it's like, look, you're selling the property. What does it matter anyway? But it does matter. And so sometimes, like you're saying, the seller of a business cares that you're keeping all the employees on because it matters. Even though they no longer have a part in the business, it's just that human element. So So finding out what's in it for them.
Yep.
That's awesome. That's awesome. Okay, let's see. Anything else that we need to discuss? I mean, this was action packed. I didn't know we were going to go in this route talking about the business, but this is exciting stuff.
Yeah. So all I would say to anybody out there that's looking to figure out where things are going, what they should be doing, now is the perfect time. I wouldn't be out there like trying to do 100 deals. If you're looking to do your first deal, now's probably not the best time to be doing your first deal. But what I'll say is 2 months from now, 6 months from now, 12 months from now, may be the perfect time to do your first deal. It may be the perfect time to start scaling if you're already doing deals, but you want to do 10 times as many. We may be entering a point in time where whether you're a real estate investor, you're a business owner, whatever other assets you're interested in buying, there may be some tremendous opportunity. So what I suggest people do now is a great time to be preparing. Now's a great time to be creating your business plan. Now's a great time to be figuring out your financial plan. Where are you going to get the money to do these things? One thing that I'm telling a lot of people to do right now is go build a team right now. So maybe you want to flip 100 houses next year. Well, no offense, but if you're new at this, you're not going to flip 100 houses next year because there's a lot of things you don't have. You don't have the time, you don't have the money, you don't have the expertise. There's a whole bunch of things you don't have. But let me tell you something. If you build a strong team, if you can bring in people that have the expertise, bring in people that have the money, bring in people that have the time to help you, now could be a perfect time to start building that team so that next year when you have 100 deals coming at you, you don't have to say, I'm going to take that one or that one. I have a whole team behind me now. I can take 10 of those deals or 20 of those deals. So now's a great time to start meeting with other people and figuring out how to put in place all the things you need to be doing not just 1 or 2 or 3 deals next year, but to be doing 10 or 20 or 50 deals next year. If you ask me my biggest regret from 2008 to 2012, it's not that we flipped 200 houses. It's that we only flipped 200 houses. I wish back then I knew about the systems and processes I know now. I wish I knew about the availability of certain types of financing. I wish I knew about how to scale a business. I wish I knew about how to bring on multiple contractor teams. I didn't know about that. And so I missed a huge opportunity back in 2008 to 12 because I didn't have the right team and the right systems and processes in place. So anybody that's getting ready to start now or looking to scale right now, today may not be the best time to do a deal, but today is certainly the best time to start thinking about what you're going to do when those deals come available.
Right. A lot of the conversations that I have are people who have been on the sidelines with wanting to be a real estate investor for a long time. And the thing that I keep telling them is just join a group, right? So I run a real estate group and we meet every single Tuesday. I have the little ticker going at the bottom, but we meet every single Tuesday. And I'm telling them, you have to learn about creative financing, raising private money, how self-directed IRAs work, all of those things, right? Have all of that in place so that when the deal comes around, you know what to do. Too many people want to just rely on bank funding and their credit and their down payments.
Yep.
Either your down payment's going to run out, the bank's not going to lend to you, or you don't have the credit to qualify. Yep. If that's your only tool, you're not going to get very far. So like you said, your biggest regret is only doing 200, not doing 2,000.
Yep.
Right. So yeah, having that knowledge in place before. The other thing is like, what's the worst time to learn how to fight? When you're in your fight, right?
Exactly.
Yeah. So when the deal comes your way, you don't want to scramble to figure it out because at that point it's almost too late. Unless you have a really patient seller, that at some point it's too late. So you want to be able to just say yes. You want to sell? Yes, I can help you. And then you have to know what to say and what not to say in negotiations. Yep. If you're doing a subject to or a seller finance, how do you say it to them without spooking them?
Yep.
That's a big one too. But that comes with experience and knowledge, role playing, all of those things.
Yep.
So yes,
and the
get ready.
And the book on negotiating real estate.
And the book on negotiating. Those books that you have are awesome. How do people buy your books?
Yes. So all 4 of the books are available through our publisher, biggerpockets.com. So if you go to biggerpockets.com/store, you can find all the books there, or they're available on amazon.com. Though I'll tell you, I don't know if you've tried to buy any books off of Amazon over the last couple of weeks, but it's like it takes, where I live, it's now taking about a month for stuff to get here. It's crazy.
Wow. So audiobooks it is then.
Audiobooks or Bigger Pockets.
Yeah. So biggerpockets.com/store. Do I have it up correctly on the screen there?
That's it.
Okay. So biggerpockets/store. Do your books come in Audible versions?
Yes. So 3 of the 4 books are Audible. So the book on estimating rehab costs is a whole bunch of charts and tables, and it would be pretty hard. It's more of a reference book than anything, so it'd be pretty hard to put that in audio format.
And more important question, are you narrating?
I am not. So luckily you do not have to listen to this voice for 8 hours.
Okay. All right. Some people might want to listen to it. Who knows?
Yeah. Brandon Turner narrates his own stuff, not me.
Right. Okay. All right. Maybe your next book. Maybe. The book on buying discounted businesses.
I love it. I might do it.
Yeah, I think you should. I think this. I'd buy it. Right. I'd buy the book. I already bought your other book. So I'd buy the book and not even read it. Just because.
Hey! You got to read it.
I know for sure.
Don't buy it if you're not going to read it.
Right. It'd be a waste.
I don't want your money if it doesn't help.
How do people reach you if you want to be reached?
Yeah. So on Facebook, I write a whole lot on Facebook these days. So if you want to read any of the stuff I'm writing, follow me on Facebook. J Scott Investor is my username on Facebook. On Instagram, JScott_123flip. Website is either 123flip.com or jscott.com. And if you want to send me an email, the letter J at jscott.com.
Did you say the website was 123flip.com?
Yep. Or jscott.com.
Okay, hold on. Trying to put them all on there.
I appreciate it.
jscott.com. Hold on.
There you go.
jscott.com. Yep.
That's it.
And then what was your Instagram name?
jscott_123flip.
jscott_123flip.
Yep.
Last one. There it is. Instagram
Perfect.
name. jscott_123flip.
Awesome.
Awesome. Well, Jay, thanks so much for everything.
Absolutely. You know, you're probably one of the last people I saw before lockdown.
Oh yeah.
I literally went into lockdown after we got together a few weeks ago.
Right.
So,
We got to drive a go-kart together.
Yes, it was fun.
Yeah. So no, it wasn't crazy. We're just sitting there, not knowing that. Right after that.
No idea.
Yeah.
No idea.
That quick.
Yeah.
That quick. So that will be forever ingrained in our memories. That right before the pandemic, we saw each other.
I'm gonna have some PTSD next time I see you.
Yeah. Every time you see me, you're gonna be like, "Oh, that's
Bad omen."
Bad omen. Thanks, Ray. All right. Well, thank you guys all for listening. This will be recorded. This will be on Facebook, and this will be also on YouTube. So check it out, and we will see you guys in the next video. See ya.
Thanks, everybody.
Bye.